Imagine walking into a boardroom and pitching a plan to just intentionally fire 700,000 of your paying customers.
I mean, you'd be laughed out of the room.
Right. In almost any industry, that is a total corporate death spiral. You'd be fired by the board immediately.
Oh, without question.
But, when UnitedHealth Group did exactly that this past April, Wall Street didn't panic at all. Instead, they sent the stock surging, like 7 to 9% in a single trading session.
Yeah, it's a fascinating reaction.
So today we are diving into a massive stack of Q1 2026 financial reports, some Morgan Stanley analyst notes, and complex valuation models. We're trying to figure out why shrinking your customer base is suddenly the ultimate growth hack in the healthcare sector.
It really is a counterintuitive playbook.
And before we get into the weeds, just a quick reminder that you are listening to our Time and Market Deep Dive. This is strictly for entertainment purposes, not financial advice. So, please consult a professional before moving your own money.
Right. And we're looking at the data as it stands today, April 25th, 2026. And the data we have right now paints this just a really fascinating picture of a company executing a deeply unexpected strategy.
Yeah, the market's reaction to UnitedHealth ticker UNH, by the way, hitting roughly $354.92 a share, wasn't just like a standard earnings beat.
No, it was a realization that they are fundamentally decoupling their primary business engines to build a long-term structural moat.
Okay, let's unpack this because, well, you just heard the disclaimer about the market moving, but let's be honest, legacy healthcare stocks aren't supposed to move like this.
They're really not. They're usually slow, steady, and hell cow.
Exactly. If you look at 2025, the entire sector was just defensive. It was weighed down by exploding medical costs. We saw competitors like CVS and Humana taking absolute beatings as utilization rates spiked.
Right. Seniors were finally getting those delayed surgeries, acuity was way up, and margins were just getting crushed across the board.
So to understand why UnitedHealth suddenly, broke from the pack and exploded upward this year, we have to look at the immediate Q1 financials. And specifically, we need to look at the one metric that dictates survival in managed care.
Medical care ratio.
Yeah.
The MCR.
Yes. Let's set the stage with the top line numbers first. Q1 revenues hit $111.7 billion.
Which is a pretty steady 2% year-over-year growth.
Right, but adjusted earnings per share came in at $7.23, crushing Wall Street's expectations by 10%.
That's a massive beat for a company this size.
And operating cash flow was an absolute mammoth at $8.9 billion. But like you said, none of that matters to the market as much as the MCR, which came in at 83.9%.
Beating the expected 85.7% and actually down from last year's 84.8%.
And for anyone listening who's, looking at their own healthcare premiums and wondering where all that money goes, the MCR is the exact mechanism.
It's literally the percentage of premium revenue that an insurer actually pays out to cover medical claims.
Right. So at 83.9%, for every dollar UnitedHealth takes in from premiums, they are spending about 84 cents on actual medical care.
Exactly. And that remaining 16 cents stays in-house for operating costs, tech investments, and, well, profit.
Right. And in an environment where Humana and CVS are struggling to keep that ratio from spiraling out of control due to rising clinical costs, it's like a massive cruise ship that somehow figured out how to burn less fuel while navigating rougher waters than all the other boats.
That's a great way to put it. It drove their operating margins up to 6.6%. And what's fascinating here is we need to look at the nuance.
Okay, hit me.
If you look at the earnings transcript from their CFO, Wayne DeVate, that 83.9% isn't just a pure operational victory.
Wait, really?
Yeah. He explicitly notes that they saw a little over $500 million in favorable net prior period development, or PYD.
Okay. Plus, they cite a noticeably softer respiratory and flu season this winter, right?
Exactly. That is the crucial nuance here. The 83.9% MCR is a victory, but it's heavily padded by accounting and seasonality.
So just to clarify, the mechanism of PYD for a second, insurers have to estimate how much they'll pay for claims that have happened but just haven't been billed yet, right?
Right. So if they estimated they'd pay out $5 billion last quarter, but the actual bills came in at $4.5 billion, that extra $500 million gets credited to the current quarter.
Which artificially lowers the current MCR.
Precisely. They were overly conservative in the past, and they get to reap the accounting benefit now.
Combine that with fewer people getting the flu, and you get a beautifully low ratio.
But that means the underlying mechanics of their cost controls haven't necessarily solved the utilization crisis of 2025. They just got a breather.
So Q2 is going to be a much sterner test when those seasonal and accounting benefits fade away.
It absolutely will be. But, that brings us to the actual operational changes they made to support the MCR.
Right, because the baseline improvement wasn't achieved by suddenly finding a magical way to negotiate cheaper surgeries.
No, it was achieved by actively amputating the sickest, least profitable parts of their portfolio.
Which brings us back to that hook, intentionally firing your customers. The sources show their total domestic membership actually dropped from 49.8 million down to 49.1 million.
They shed 1.3 million Medicare Advantage members.
And shrank their individual ACA Obamacare business by a full third. I mean, normally, a company losing 700,000 customers is a massive red flag. Why is Wall Street cheering for a shrinking customer base?
Because they are prioritizing high-value profitability over sheer volume. In 2025, the whole industry got wrecked by volatile utilization trends in ACA and Medicare Advantage plans.
Right, the ACA exchanges in particular have massive churn.
Huge churn. You get patients hopping onto a plan, getting a backlog of really expensive procedures done, and then just dropping the coverage. It makes the risk pool incredibly unpredictable.
So UnitedHealth looked at the data and just cut the cord. They stopped competing for market share in regions where the pricing just didn't make sense.
They did. They're isolating themselves. They're shifting away from those volatile contracts and leaning aggressively into HMO-based products.
Right, because in an HMO model, the insurer has much tighter control over the care pathway.
Exactly. You have narrower provider networks and often capitated payment models where the provider gets a flat fee per patient.
Which transfers some of the clinical risk off UnitedHealth's balance sheet and directly onto the doctor.
Yep. By doing this, they are building a smaller but vastly more fortified insurance portfolio.
Okay, so it's like a nightclub that realizes the packed dance floor is actually losing them money because of high security costs. So they intentionally kick out a third of the crowd, raise the cover charge, and turn it into a VIP lounge.
That's a perfect analogy. Fewer people, but wildly higher margins.
But here's where it gets really interesting. They aren't just hoarding that $8.9 billion in operating cash flow.
No, they are not.
If you are analyzing businesses for your own portfolio, this is where their capital allocation strategy just becomes a masterclass. They're using the excess liquidity to fund a massive technological overhaul at Optum.
Right, Optum being their health services and tech division. This is the other half of that decoupling strategy we talked about.
And management is intentionally allowing Optum's earnings to contract in the near term, right? Operating income there actually fell 15% to $3.3 billion for Q1.
And they are perfectly fine taking that hit because they are funneling $1.5 billion into AI and modernization in 2026 alone.
$1.5 billion. I want to dig into the mechanics of this because we aren't just talking about, upgrading to a better version of Excel. We're talking about automating the most agonizing choke points in healthcare.
They have to. They're reacting to an existential threat. Across the industry, clinical labor costs and persistent wage inflation are squeezing margins to death.
Provider burnout is at an all-time high.
And administrative bloat is just consuming revenue. If UnitedHealth doesn't automate routine tasks right now, the labor costs will eventually eclipse their premium growth.
So let's look at how this AI actually works. The sources mention their prior authorization tool called PreCheck. The stats here are wild.
They really are.
They reduced prescription prior authorization times from over 8 hours to under 30 seconds. How is that functionally happening?
Well, think about the old manual process of prior authorization. A human administrator has to read through unstructured physician notes, cross-reference them against a massive database of the patient's specific insurance plan.
Check the clinical guidelines for that specific generic or brand name drug.
Exactly. And then make a ruling. It's incredibly tedious and prone to human error.
But what PreCheck is doing is using natural language processing to ingest the doctor's notes instantly, match the diagnostic codes to the pharmacy benefit rules in milliseconds, and just spit out an approval.
Right. And because the AI doesn't get tired or misread a code, it comes with a 68% reduction in denials due to missing information.
Oh, wow.
And an 88% reduction in appeals.
That fundamentally changes the paradigm for a patient waiting at the pharmacy counter.
It completely changes the game.
Yeah.
But it's not just pharmacy.
Right. They have an AI claims platform called Optum Real that is cutting manual adjudication costs by 76%. 76%. And they rolled out an AI chatbot named Avery to 20 million members to handle routine benefit questions.
Which has already reduced call center volume by 25%. I mean, you can literally see the labor costs evaporating.
Which is why management is explicitly targeting a 2-to-1 financial return on these AI programs. They expect many of them to pay for themselves within 12 to 18 months.
That's incredibly fast ROI for enterprise tech.
It is. If we connect this to the bigger picture, Optum is transitioning from a traditional labor-heavy healthcare service provider into an AI-first enterprise software firm.
And that is the ultimate play. Once they perfect these proprietary tools internally, they are going to license them out.
Exactly. They'll sell these tools to the rest of the healthcare industry, hospital networks, rival insurers.
So with margins stabilizing on the insurance side through ruthless portfolio cuts and this massive AI software engine scaling on the Optum side, how is the market actually pricing the stock today? Let's talk valuation. Well, at around $354 a share, a casual observer might think they missed the boat, especially after a 7 to 9% pop.
Right.
But when you look at the multiples, the stock is currently trading at around 18 to 19 times forward earnings.
Which, historically speaking, is actually a massive discount.
It really is. The 5 to 10-year historical average for UNH is typically around 22 to 24 times forward earnings.
And Morgan Stanley put out a note showing that if you look out to 2028, it's trading at just 13.7 times their projected EPS.
That is well below the 10-year historical forward average of 15.2 times.
Okay, I want to get into the hard math of the valuation models provided in our sources, specifically the 10-year discounted cash flow analysis, the DCF model from TIKR.
Let's do it.
I know our audience is familiar with DCF models, so we don't need to define the concept, but let's debate the specific inputs they are using to justify this stock price.
Sounds good. So the model uses that massive $8.9 billion operating cash flow as the free cash flow base.
Right, from Q1.
From Q1, yeah. And from there, it projects outward over the next 10 years using a 9% growth expectation.
My immediate thought looking at that is, isn't 9% a bit pessimistic for a company building an AI enterprise software wing? I mean, their 10-year historical revenue growth sits closer to, what, 11%?
It is conservative, but intentionally so. The 9% assumes a 5.6% revenue compound annual growth rate and a 5.0% net income margin.
Okay.
Remember, their margins used to sit above 6% before the recent utilization spikes, and they just hit 6.6% this quarter. So the model is baking in a significant margin of safety.
Got it. It assumes solid growth is supported by these AI efficiency savings, but it doesn't assume they completely monopolize the industry or that clinical inflation magically drops to zero.
Exactly. It's a grounded model.
Fair enough. So for the terminal value calculation, the model uses a standard 2.5% terminal growth rate, which roughly mirrors long-term baseline economic growth and applies a 10% discount rate to account for market risk and the time value of money.
Right. And when you run those inputs, the final calculated intrinsic value comes out to $640 per share.
$640. That is staggering when you compare it to the current price of roughly $355.
It implies an 81% upside to intrinsic value.
And current analyst sentiment heavily supports this bullish outlook. I mean, Morgan Stanley maintained their overweight rating, named it a top pick, and raised their near-term price target to $395.
They're very confident in the pivot.
But what really stands out is that management isn't just releasing optimistic press releases, they are weaponizing their balance sheet.
I say.
They are accelerating $2 billion in share buybacks by the end of Q2, specifically citing a, quote, deep intrinsic value discount.
Yeah.
If management is essentially backing up the truck to buy their own stock, is this as much of a sure thing as it looks?
It's a strong signal, but in the market, signals aren't guarantees. Every bull case has its shadows. If you were going to look at that $640 intrinsic value and the 18 times multiple and think this is a sure thing, you are ignoring the massive execution risks standing in front of them right now.
Okay, so let's get into the bear case. Because before anyone decides how to view UNH, they need to understand the structural headwinds.
And there are a few big ones. First, look at their Medicaid portfolio. It looks like a bleeding wound right now.
We talked about how they fixed Medicare Advantage and the ACA by shedding members, but Medicaid margins are expected to remain deeply negative through all of 2026.
Yes, and it comes down to the mechanism of state funding lags. When states conducted their post-pandemic Medicaid redeterminations, basically kicking ineligible people off the rolls, the people who stayed on were generally the sickest patients.
The ones with the highest acuity needs.
Exactly. So the risk pool severely degraded.
Yeah.
But state governments adjust their capitated payment rates based on historical data, not real-time data.
Oh, man. So the states are paying UnitedHealth rates based on the healthier 2024 pool, but UnitedHealth is currently paying for the much sicker 2026 pool.
Precisely. The funding is currently insufficient to cover the medical costs, and management doesn't expect even modest improvements there until 2027 when state rate negotiations finally catch up to reality.
So UnitedHealth just has to eat those losses in the meantime.
Yeah, and how much of this 1.5 billion AI saving is just going to be eaten up by negative Medicaid margins? It's a real question.
And that ties directly into the seasonality risk of that MCR we discussed earlier. The second half of the year carries a heavier medical cost burden, right?
Much heavier. Management was very clear that over 75% of UnitedHealthcare's earnings are expected in the first half of the year.
Meaning Q2 MCR seasonality is expected to look worse than Q1.
If those AI tools don't scale fast enough to offset the administrative costs, or if utilization spikes again in H2 without the cushion of favorable accounting developments, that 83.9% MCR could balloon quickly.
And Wall Street will absolutely punish them for it.
Without a doubt.
There is also a highly localized accounting issue hanging over Optum Health, the Premium Deficiency Reserve, or PDR. The sources show Optum Health currently holds a PDR liability of over $600 million for the full year.
Right, for contracts still under negotiation.
Explain how that functions as a risk.
Well, a premium deficiency reserve is essentially an admission of defeat on specific contracts. It's an accounting mechanism where the company sets aside cash today because they know contracts they have already signed with provider groups are going to bleed money for the rest of the year.
Yikes. So the premiums they are collecting simply won't cover the medical costs they are obligated to pay.
Exactly. So they are actively renegotiating these underwater contracts. And if they can't force the provider groups into pricing alignment, they will have to exit those contracts entirely.
Which means losing that revenue stream and taking the write-down.
Correct. It's a $600 million point of friction that requires flawless execution to resolve without damaging their provider networks.
So they are fighting a multi-front war here. State budgets, provider contract negotiations.
And we can't ignore the localized legislative risks either.
Oh, like the pharmacy benefit manager battle in Tennessee.
Yeah. State legislation there could negatively impact access for nearly 150,000 specialized patients, which threatens Optum Rx's revenue in that state.
Okay, so what does this all mean? Based on everything in our source stack today, the discounted multiples, the 10-year DCF intrinsic value of $640, the AI transformation versus the undeniable structural headwinds of Medicaid funding and back half MCR seasonality. Where does this net out?
Well, based on the consensus from the analyst models and the stark discount to historical multiples, UnitedHealth is widely viewed as a buy or a stronghold for long-term investors.
Assuming they're willing to wait out the H2 2026 execution risks.
Exactly. The verdict hinges entirely on your time horizon. If you are looking for a smooth upward trajectory over the next 6 months, the Q3 and Q4 execution risks might burn you.
But if you are buying based on the 10-year intrinsic value calculation, you are getting a foundational healthcare asset transitioning into a high-margin tech company at a historically cheap entry point.
It's a classic trade-off, enduring short-term volatility to capture long-term structural improvement.
And, if you take one thing away from this deep dive, whether you are managing your own portfolio, analyzing businesses, or leading a team, there is a profound lesson here about the courage to shrink in order to grow stronger.
It really is a phenomenal example of disciplined capital allocation.
UnitedHealth didn't panic when utilization spiked. They took the hit to their ego, shed the unprofitable market share, ignored the vanity metrics of total membership, and aggressively funneled that preserved cash into the exact technology that will secure their next decade.
They traded short-term membership vanity metrics for long-term operational moats. But, this raises an important question.
What's that?
If UnitedHealth successfully automates the most expensive, agonizing administrative parts of healthcare with AI, will those massive savings eventually trickle down to lower premiums for the patient? Or will they simply build an insurmountable $640 per share fortress of profitability for the company?
Oh, wow. Yeah, that is the multi-billion-dollar question, and one we will certainly be watching closely as these AI tools roll out. Thank you so much for joining us on this deep dive. Keep questioning the models, keep looking for the mechanisms behind the headlines, and we'll see you next time.